You know, the idea of striking it rich in the stock market, that fantasy of getting wealthy fast, it's really powerful, isn't it?
Oh, absolutely. It's been the dream for generations ever since the market became this, well, this huge wealth machine.
Right. Billions changing hands daily, people from everywhere just hoping for that breakthrough. And it was that whole allure, that constant question that really got me thinking when I wrote my article over on polishbooks.com, the big one. Can you actually get rich quick in the stock market?
It's the million-dollar question. Or maybe the multi-million-dollar question these days.
Exactly. And the story I dug into, I think it really offers some fascinating answers.
So where do you start with that? There are so many ways people try to tackle the market.
Well, yeah, you pretty quickly land in these two major camps, right? You've got your fundamental analysis folks.
Digging into the company itself, the profits, the debt, the management, is the business solid?
Precisely. And then on the other side, you have technical analysis.
Which is all about the charts, the price action, the volume. Forget the company. Just watch the stock's behavior.
And the debate over which one is better or right, well, it's endless.
It really is. You've got legends in both corners.
For sure. Like when you think fundamentals and long-term success, who pops into your head?
Gotta be Buffett, right? Warren Buffett. Buy good businesses, hold forever.
He's the icon.
Mhm.
And his success makes a lot of people think anything faster, any other method is just, gambling, pure speculation.
Dismisses anything that looks like market timing or chart reading.
But then you find these other stories that maybe challenge that view. And the one I focused on in my article, Nicolas Darvas, he's just such a compelling counter-argument.
Ah, Darvas, the dancer, right. That's always such an unexpected background.
Totally unexpected. Professional dancer, zero formal finance training. But somehow he pulls together this massive fortune, like millions, in under 2 years. His strategy, well, it was pretty different. Revolutionary, some called it.
So how does a dancer even get started in stocks? It seems like worlds apart.
Almost by accident, actually. He got paid for a dance gig with some stock.
Okay, that's unusual.
Right. And he holds on to it for a bit, then sells it, and bam, makes an $8,000 profit. Which, back then, that was serious money. Like maybe 80 grand today.
Wow. Okay. I can see how that would get your attention.
Oh, it hooked him completely.
Yeah.
That quick, easy profit made him think, hey, this is the path. So like a lot of beginners, maybe, he just dove in.
Head first, probably. Buying based on tips.
Yep, tips, recommendations, whatever sounded hot, thinking he'd found the secret sauce.
Which usually doesn't end well.
No. The market tends to teach you lessons the hard way, and Darvas learned his. But instead of pausing, he kind of doubled down.
Oh, dear. More money in.
Yeah. Sunk about $10,000 into really aggressive day trading.
Yeah.
Chasing tips, rumors, even those shady unlisted stocks.
Oof. The classic pitfalls. Red flags everywhere.
Big time. And predictably, it blew up. He lost money.
Yeah.
It forced him to admit, okay, this isn't investing. This is just gambling.
A painful but necessary realization for a lot of people.
Definitely. So that failure actually prompted a big shift. He decided, okay, I need to do this the right way. He went all in on fundamental analysis.
So hitting the books, learning about balance sheets, income statements.
The whole deal. Poring over financial reports, looking for ratios, identifying companies that seemed really solid fundamentally. Strong balance sheets, leaders in their industry, you know the type.
The buy and hold blue chip approach, essentially.
Kind of. He picked out what he thought were these impeccable companies and put about $50,000 into them.
Okay. Seemed like a much more sensible strategy after the gambling phase.
You'd think so.
Yeah.
But here's the twist. Within 2 weeks, he'd lost over 9 grand.
What? On the fundamentally strong stocks?
Yep. He panicked, sold everything, liquidated the whole portfolio.
Wow, that must have been gut-wrenching after trying to do it by the book.
Totally. And then, almost desperately, he threw his remaining cash into some stock he picked, almost at random.
Seriously, after all that fundamental research?
I know. And guess what? That random pick actually made back about half his losses.
You're kidding. That would mess with your head.
Completely. He was deeply shaken. It made him question everything, especially whether fundamental analysis alone was the guaranteed path people made it out to be.
So first tips failed, then pure fundamentals failed. Where did he go from there?
He started thinking, maybe it's not just the company, maybe it's how the market itself moves. The psychology, the trends.
Ah, so shifting focus from the what to the how, market behavior.
Exactly. He became this obsessive student of technical analysis, reading every book he could find, studying stock tables relentlessly, charting price movements by hand.
That's some serious dedication, turning the ship completely.
And out of all that study, he developed his famous box theory.
Right, the boxes. Can you explain that a bit?
Sure. He basically started identifying trading ranges for stocks. Like a stock would bounce between a certain high price and a certain low price for a while. He visualized that as a box.
Okay, a price range?
Yeah. The top of the box was resistance, the bottom was support. If the price broke out above the top of the box, that was his buy signal. If it fell below the bottom, sell signal.
So, anticipating modern support and resistance concepts, really, buying breakout.
Pretty much. It was an early way to systematize buying strength and selling weakness based purely on price. But initially, his success rate was like coin flip odds, maybe 50%.
Not exactly stellar. Enough to make some people give up again.
But not Darvas. He kept at it, refining his chart reading skills. And this is crucial. He discovered the absolute power of stop-loss orders.
Risk management. The essential ingredient.
Totally essential. It became a rigid rule for him. If a stock dropped to a certain point after he bought it, boom, he was out automatically. No second guessing, just limit the damage.
That discipline is key, especially if you're dealing with volatile stocks or later leverage.
Exactly. And then came the really interesting part. He started blending the two worlds.
Technical and fundamental, how did he combine them?
He didn't ditch fundamentals entirely. Instead, he used them to understand why a stock might be moving the way his technical signals indicated. What was the story, the potential catalyst behind the price action?
So fundamentals is context, not the primary trigger.
Precisely. He looked for what he called fashionable stocks, companies in hot emerging industries that had momentum, excitement, a narrative.
Growth stocks, basically, things people were talking about.
Right. But here's the key. He did his own analysis. He tuned out all the noise, the rumors, the Wall Street opinions, fiercely independent.
Trusting his system above all else.
And that led to his big breakthrough. Bruce C., E.L. Bruce Company.
The hardwood flooring company from Memphis. That doesn't sound very fashionable or high-tech.
It wasn't. Fundamentally, maybe it looked okay, nothing spectacular, but technically. According to his box theory, it was setting up perfectly. It kept hitting new highs, forming new boxes.
So the price action was telling a strong story.
A very strong story. Strong enough that Darvas made an incredibly bold move. He put over $130,000 into Bruce, around $50 a share.
Whoa, $130 K. That's a huge position. Did he borrow money for that?
He did. He used leverage, which, again, highlights why those stop losses were absolutely non-negotiable for him. Big potential reward, but also big potential risk.
Okay, so huge bet on Brucey based on technicals. What happened?
Well, a lot of the smart money on Wall Street was actually shorting Brucey, betting it would fall.
Going against the crowd.
Completely. And the crowd was wrong. Bruce hadn't fallen. It exploded. It rocketed past $100 a share.
Wow. He must have been tempted to take profits there. That's already a double.
Oh, imagine the internal battle. Huge gains on paper. But he stuck to his technical system. The chart still looked strong. The boxes kept forming higher.
So he held. Nerves of steel or just faith in the system?
Probably both. He eventually sold, scaling out at an average price around $171 per share.
From $50 to $171, the profit must have been enormous.
Around $300,000 profit on that one trade.
Incredible. And that wasn't a one-off.
Not at all.
Yeah.
He replicated that success, made another $400,000 on Universal Products, then a whopping $860,000 on Thiokol Chemical.
Just rolling the profits into the next technically strong setup.
Exactly. Reinvesting gains following his techno-fundamentalist system. In less than 2 years, he turned his initial stake into over $2 million.
Which is like, what, $20 million today? Phenomenal.
Just staggering. And it came from this unique blend of principles.
So, what are the core takeaways from his method? What made it work?
Well, first, the emphasis on price action. Often before the fundamentals confirmed the move, he saw price as a leading indicator.
Right. The market anticipating news.
He also ran a very concentrated portfolio, not the diversification most advisors preach. Big bets on a few names.
Higher risk, higher potential reward.
But managed with leverage, used strategically, always paired with those strict stop losses. That part's critical. And finally, that fierce independence, trusting his own system, ignoring the noise.
It really challenges conventional wisdom on several fronts.
It does. And some of his sayings are just gold, like buy high and sell higher.
Completely counterintuitive to the buy low, sell high mantra.
Or jog along with the trend. Don't fight the market momentum. And my favorite, maybe, financial statements tell you the past and present. They can't tell you the future.
That really captures his view on the limits of just looking at past data.
So bringing this to today's market,
Hmm.
is getting rich quick, Darvas style, still possible? What's the relevance now?
Well, his story proves rapid wealth is possible through trading. It's not pure fantasy. And it's a huge, but it wasn't luck.
No, absolutely not. It was years of intense study, failure, refinement, building a disciplined, systematic approach.
Exactly. It wasn't a get-rich-quick scheme. It was get-rich through incredibly hard work and discipline relatively quickly.
That's a good way to put it.
Hmm.
Sometimes I wonder if we overcomplicate investing today. His core ideas follow trends, cut losses. They seem timeless.
They really do. Of course, some critics say his box theory is too simple for modern algorithmic markets.
Yeah, I've heard that. But I think that misses the point. It's not about copying the exact boxes. It's about the underlying principles.
The discipline, the risk management, the blend of analysis.
Right. And think about the advantages we have now. Real-time data, instant trades, no commissions, amazing charting tools. Things Darvas could only dream of.
True, the tools are infinitely better. But the psychology, the discipline required, maybe even harder with more information and speed.
That's a fair point. The core lessons, patience, discipline, constant learning, they're arguably more important now because the noise is louder.
So the message for listeners isn't go trade like Darvas.
Definitely not. Don't just try to copy his boxes. Focus on the why. Develop your own consistent method. Maybe it's more technical, maybe more fundamental, maybe it's a blend like his. Find what works for you.
And be incredibly disciplined about it, especially managing risk, cutting losses.
Absolutely. Protect your capital and commit to learning. The market's always changing. You have to adapt.
So Jarvis is less a specific roadmap, more an inspiration and a set of principles.
I think so. It shows significant wealth can be built if you approach it right. What I personally love is how he found a strategy that fit him. His risk tolerance, his way of thinking. He didn't just follow a guru.
He built his own well-tested approach, right? Through trial and, importantly, error. Lots of error early on.
A ton of error. His whole journey is really about learning from both wins and losses, adapting, evolving. That's the real key.
So what's an actionable step someone listening could take away from this?
Okay, good question. How about this? Take some time this week. Maybe look at your own approach. Are you relying too much on just one thing? Could blending in some technical chart reading, even basic support and resistance help?
Or maybe digging a bit deeper into the why behind a stock's move, even if you're mostly technical, looking at a simple fundamental ratio, perhaps?
Yeah, exactly, like the price-to-earnings ratio, just to get a feel for valuation. Start small, explore how different analyses could complement each other, and think about your rules for cutting losses. Are they clear? Are you sticking to them?
That self-reflection is crucial.
It really is. And, if you want to dive deeper into understanding technical or fundamental analysis, we cover a lot of that over at bullishbooks.com.
Right, you have sections on those specific topics.
We do. Check out the Wealth Wisdom or Investors Bookshelf sections. Lots of articles and resources there to help you build your own understanding.
Good place to start learning more.
And of course, if you want to catch all our deep dives like this one, exploring different investing strategies and stories, just subscribe for updates at bullishbooks.com.
Stay in the loop.
Definitely. So let's leave everyone with a final thought to chew on.
Okay, let's hear it.
What if the real key, the secret to unlocking the market's potential, isn't about finding the one single right way to invest, but about intelligently blending different perspectives, different tools, to create your own unique edge in the market?